On January 30th, 2026, silver lost $51 in one violent trading session, falling sharply from $121 straight down to $70. That $51 vanished in hours. It was not a gentle retreat or modest pullback, it was a sheer cliff. This marked the biggest single-day drop in silver prices since 1980. Experts called it a 6 sigma anomaly, a near-impossible statistical outlier. More than $7 trillion evaporated from worldwide markets in just 48 hours. Retail investors endured brutal margin calls and widespread account liquidations. Bullion dealers from Dubai to Switzerland reported completely empty inventories. While global panic dominated trading screens and positions were erased in real time, one individual remained calm, strategic, and substantially profitable. Nobody knows his name. He avoids interviews and ignores all correspondence. He works quietly from a modest office in Gibraltar, distant from major financial centers. On that precise day, he controlled the planet's largest short position in silver, 30,000 contracts, equivalent to roughly 450 tons of physical silver exposure. According to Bloomberg on February 5th, his paper profits neared $288 million. After accounting for earlier losses, net gains stood at approximately $144 million. One single trade generated massive wealth. Yet the story goes far beyond that. Events on January 30th, February 5th, and what is still unfolding exposed deep cracks, a serious fracture in the silver market that could fundamentally reshape precious metals. Later, I will present Shanghai volume figures from February 5th morning, rarely discussed. This may currently be the single most revealing statistic in all commodities. I will also disclose who this trader really is, how he built his fortune, and why his involvement completely transforms the entire narrative. By the video's end, you will fully understand the significance. Welcome to SmartFination. If you're new, please subscribe. A quick like takes 2 seconds and genuinely helps this kind of detailed analysis reach more viewers. Now let's examine what actually happened beneath the headlines. Every major financial outlet ran nearly identical stories last week. Silver collapses, gold weakens, Horsch nomination disrupts markets. They conveniently omitted one crucial detail. Silver dropped more than 3 times as hard as gold. If this were simply stronger dollar and higher rate expectations, why the extreme difference? Both metals are dollar priced and respond to similar macroeconomic forces. Yet silver was devastated, while gold experienced only a moderate setback. That asymmetry is the real clue most sources failed to explain properly. Once you grasp it, silver price charts will never appear the same again. The widely accepted version of events is straightforward and partially correct. On January 30th, Trump nominated Kevin Warsh to become Federal Reserve Chair. Warsh is widely seen as a monetary hawk favoring tighter policy. Markets interpreted this as higher for longer interest rates and a surging dollar. Since precious metals are priced in dollars, both gold and silver declined. That narrative is accurate, but covers only about 10% of the full picture. The remaining 90% echoes the scale and dynamics of the 1980 Hunt Brothers saga. Beneath the surface lay organized unwinding of leveraged positions, plus aggressive short selling. CFTC commitment data showed speculative net longs in silver near historic highs. The entire market was positioned extremely one-sided heading into that week. Then the catalyst struck. Morgan Stanley quants detected massive forced rebalancing inside leveraged silver ETFs. iShares Silver Trust alone faced roughly $3.5 billion in compelled selling on January 30th, enormous volume from one vehicle in one day. CME Group then escalated the pressure by raising COMEX silver margin requirements. Margins increased from 11% to 15% right in the middle of the sharp sell-off. Raising margins during a crash mechanically forces underfunded leveraged traders to liquidate positions immediately into a declining market. This accelerates the fall, triggers more margin calls, and creates a cascading spiral. It becomes a self-reinforcing death loop of selling and falling prices. This exact environment allowed our mysterious trader to position perfectly opposite. He remained private, based in Gibraltar, and earned about $144 million net profit. Now I will reveal his identity and why his role matters so much. His name is beyond shaming. Once you learn his track record over 4 years, his participation in the silver event takes on far greater importance. This Chinese billionaire generated over $3 billion going long gold on Shanghai futures since 2022. He ranks among the most consistently successful metals traders alive. After profiting heavily from rising metals prices, he reversed direction completely. He then profited substantially from silver's dramatic decline. Bloomberg reported on February 5th, 2026, that Bian had built large short positions through Zhongkai futures. Exchange records showed Zhongkai's silver short exposure reached 18,000 lots by January 28th, 2 days before the major collapse began. By January 30th, silver's Shanghai peak, his position climbed to approximately 28,000 lots. He added 10,000 more contracts right at the absolute high. Total position reached roughly 30,000 contracts, and that equates to about 450 tons of physical silver equivalent exposure. I am not alleging he triggered the crash or possessed non-public information. What is undeniable, a trader who made $3 billion reading gold correctly placed an enormous bearish silver bet at the precise right moment. The timing is almost unnervingly perfect. Bloomberg data analysis indicated he began establishing the short position back in November 2025, aiming for the top. Early attempts produced losses. Earlier still, in August 2025, his long silver trades generated over 1.3 billion yuan in profits. He gained going up, then flipped and gained going down. My view after careful reflection this week is straightforward and honest. Bian simply understood the market better than most. Silver had gone parabolic, rising from around $30 early in 2025 to over $121 by January 29th. A fourfold increase in under 12 months is historically unsustainable. Regardless of fundamentals, such rapid rallies create dangerous leverage underneath. Extreme moves build explosive speculative positions that eventually collapse. He identified overcrowding, excessive gearing, and wagered reversion was imminent. Gravity eventually prevailed, and it prevailed spectacularly. What disturbs me most deeply is one trader through one brokerage holding the dominant net short position across the entire Shanghai Futures Exchange. Personal capital and select client funds were all aligned in the same conviction. He earned at least $144 million, while the broader market suffered enormous losses. Certain estimates place his total gains closer to $500 million. Now, the physical silver market tells an entirely different and troubling story. While COMEX paper prices crashed to $70, physical markets showed extreme divergence. On February 2nd, the identical ounce of silver traded at dramatically different levels. New York COMEX around $80, Japan around $120, 50% difference on the same day. Shanghai Gold Exchange quoted $111. India priced it at $93. Kuwait at $106. Dubai showed $91 plus a 18% premium over reported spot. Every major physical hub priced silver differently on the same date. Analyst Shanaka Pereira described this as the largest sustained divergence. In precious metals price history, same chemical element, same day, up to 40% variation. In a functioning market, arbitrage should erase such spreads within minutes, yet the gap persisted. Trading key analysis pointed to silver lease rates surging to 708%. When borrowing costs, freight, and insurance are factored in, arbitrage becomes economically unviable. The global price equalization mechanism broke. Khaleej Times reported on January 31st that physical silver bars were unavailable in Dubai. Traders confirmed inventories were completely exhausted. Buyers paid 2,000 dirhams per kilogram above market just to secure any metal at all. One Dubai dealer from Almanar Gold stated silver was simply not present in the market. In Switzerland, a leading bullion house reported zero silver inventory for weeks. No replenishment occurred. Any customer sellback was instantly absorbed. Nothing remained for new buyers. Gold coins and small bars were also sold out. Only large gold bars were still available in limited quantity. Now connect these critical observations carefully. COMEX paper says $80, Shanghai Physical says over $100. Dubai says unobtainable at any price. Switzerland says literally zero inventory exists on dealer shelves. COMEX paper to physical ratio is estimated near 350 claims to 1 real ounce. 350 paper positions for every deliverable ounce of metal. That number alone should make anyone pause. The math simply does not add up. What happened next, February 5th, reveals something truly extraordinary. Shanghai Futures Exchange data showed 1,396,553 April silver contracts traded in the morning session alone. Each SHFE contract represents 15 kilograms. That single morning session equaled approximately 674 million ounces of silver. Adding all other silver contracts traded that morning produced roughly 1.34 billion ounces. Global annual silver mine production is only 800 to 850 million ounces per year. One half-day session on one exchange nearly doubled the entire yearly mine supply. When I first read this figure, I assumed it was a reporting error. I verified SHFE contract specifications myself, 15 kilo per lot, and recalculated thrice. The numbers hold true every time. One analyst called it the most astonishing event in Asian commodity market history. I am inclined to agree completely. This was not ordinary retail trading activity on phones or apps. It appeared to be a deliberate, massive, concentrated short-selling assault designed to force the Chinese silver price significantly lower. Despite that enormous paper volume dumped on the market, Shanghai silver still closed at a substantial premium over COMEX prices. The premium survived. Shanghai finished above $112, while COMEX hovered near $77. The $17 gap returned. Backwardation persisted. Near-term delivery commanded higher prices than future. This signals genuine physical tightness that paper selling could not overcome. You can flood the market with nearly 2 years of global mine production in one morning session, and the physical premium refuses to disappear. That single fact reveals where real power actually resides in this market. It is not with paper traders pushing prices around. It is with whoever holds the actual deliverable physical metal. Another important data point reinforces this. CEIC records show Shanghai futures silver inventories declined sharply. 26 tons vanished in a single day alone. Stocks fell from 482 tons to 455 tons, then from 449 tons on February 3rd to 423 tons on February 4th. For a historical perspective, SHFE silver inventories peaked above 3,110 tons in January 2021. They now stand at only 423 tons, 86% reduction. Real metal is physically leaving exchange warehouses at a rapid pace. China's industrial consumption, solar panels, electronics, high-tech manufacturing, is absorbing silver faster than new supply can possibly replace it. The structural reality creates a striking paradox with the January crash. Headlines declared silver finished, bubble burst, story over. But the fundamental supply-demand picture screams exactly the opposite. I have tracked silver dynamics for many years, and nothing compares to this. On January the 1st, 2026, China officially reclassified silver as a strategic resource. Only 44 companies received export approval for 2026 and 2027 combined. That covers approximately 121 million ounces annually, 60 to 70% of globally refined silver. The world's largest silver refiner just imposed government controls on exports. You do not designate a commodity strategic unless you intend to retain more domestically. I have emphasized this point for months. Government hoarding or export restrictions represent the clearest possible signal of rising long-term value expectations. Samsung, one of the world's largest technology conglomerates, secured 100% of output from Mexico's La Perla silver mine for the next 2 years. They made a direct $7 million prepayment to the mine itself, bypassing exchanges entirely. No COMEX futures, no ETFs, no paper instruments, straight to physical source. When industrial giants bypass conventional markets for guaranteed delivery, it reveals deep distrust in paper-based systems to actually provide metal. That insight is central. Sophisticated buyers are abandoning paper markets and seeking direct physical supply wherever possible. A government is stockpiling. A mega corporation is locking up entire mine production. Exchanges are losing credibility. If those facts do not force a complete rethink of how silver operates, nothing will. Another critical timeline issue mainstream finance rarely discusses, even with elevated prices, new silver mining projects require 7 to 10 years to reach production. Supply response is effectively frozen for the next decade. Silver has remained in structural deficit for 6 consecutive years already. That deficit continues widening each year without exception. Solar panels alone consumed over 200 million ounces last year. Electric vehicles, artificial intelligence infrastructure, 5G networks, medical devices, all demand silver with no realistic substitute available. Physics prevents removing silver from solar photovoltaic cells. Even the state of Wyoming announced on February 3rd it selected a local vault for storing its physical precious metals holdings. When a U.S. state government actively secures real gold and silver, it signals a fundamental shift in how institutions perceive these assets. Now, my honest assessment, starting with the bearish view for balance. Kevin Warsh, as Fed chair, implies higher rates, longer, stronger dollar, metals pressure. Silver's parabolic rally required a sharp correction. JP Morgan warned of $50 potential. BN Shaming, a proven $3 billion metals winner, is actively short silver. If he sees downside risk, it deserves serious consideration. Volatility is real. A $51 single-day drop can destroy leverage positions in hours. That risk must be acknowledged clearly and without sugarcoating. Now here is where I diverge strongly after deep analysis this week. January 30th was overwhelmingly a leverage-driven event, not a fundamental one. That distinction is enormous. Leverage events reflect positioning extremes, not changes in underlying asset value. Physical market evidence confirms this. Shanghai physical prices held above $100 throughout the worst of the panic. Dubai metal was unavailable at any quoted price. Switzerland shelves were empty. Structural deficit persists with no meaningful supply increase for 7 to 10 years. China restricted exports starting January 1st. Industrial demand accelerates quarterly. COMEX registered inventories lost 26% in just days. LBMA holdings down 40% since 2021. Silver lease rates exploded from 0.5% to 8% and have not retreated. This is not a burst bubble. This is a market where physical metal is genuinely scarce while paper markets pretend normalcy. During secular gold bull markets, if gold reaches 6,000 and ratio compresses to 45.1, silver would trade near $133. At 41, it would reach $150. My personal opinion, not advice, is that this is one of the most asymmetric setups I've observed in commodities. Patient physical ownership offers far superior risk-reward compared to leveraged paper trading. Paper can manipulate short-term. We witnessed it happen in real time. But paper cannot manufacture real silver. Physical reality eventually prevails, always has, always will. Paper currently claims $77. Physical reality says metal is unavailable near $100. One of those valuations is incorrect. Commodity history is unambiguous. When paper and physical diverge dramatically and persistently, paper adjusts. Now, I want your perspective. Where will silver trade by December 2026? Will paper momentum continue dominating, or will physical constraints take over? Please share your end-of-year price target in the comments below. I read every single comment and pinned the strongest analysis I find. If this breakdown clarified recent silver market chaos for you, please share it widely, send to friends, post on X, spread understanding. To support continued independent deep dive content like this, consider joining. This is SmartFination, where the true story always lies beneath the surface. See you in the next update.